everyone, and welcome to another edition of the Maybom Perspective, where we talk all things real estate. And good to be with you today. I'm John Chambers, broker and general manager at Maybom Real Estate, and joined today by Mr. John Cates, who is our president and also very knowledgeable about the real estate industry on a broad level. And so just wanted to pick your brain today.
Yeah, no, happy to be here.
Yep. Good to see you as always.
Yep.
And just wanted to pick your brain on a few things and see what you thought about the upcoming year and what's happening around us.
Yeah.
And so, you know when I talk about real estate and people ask me about it, it seems like the first thing that comes up is the inventory. You know, how many houses are on the market and are things moving?
Right.
And as we see it to continue to tick up, what are you seeing there as far as what's out there, how it's moving, how it's affecting us, what's causing it to creep up?
Yeah, absolutely. So, I mean, going back even, through COVID, there was no inventory because everything sold quickly, had multiple offers. It was a crazy market. And then since then, it's slowly ticked back up. Slowly. It's taken a few years now. And recently, inventory is back up to about where I would say a pretty normal, healthy area, which is, 4 to 5 months is normally pretty good. Mm-hmm. That means that buyers have got options. They can take the time to get an inspection done, all those different things that they would need to make an informed decision to buy a house. But I don't see inventory really going much higher. The reason for that is, I think, and we'll talk about mortgage rates in a minute, but what we've seen in the past is as rates tick up, buyers get a little more cautious. Mm-hmm. They kind of sit on the fence and wait a little bit. And then once they hit a certain point, those people kind of jump off the fence and start to buy again. When that happens, inventory obviously comes down. There is a good bit of new construction going on in our area, but it's not near enough, to be honest, to meet the demand or to really have that much of an impact on inventory. I think there was a study that came out about 3 months ago that said we're still about 17,500 homes, new homes, not just resale homes, new homes short of meeting the demand that exists. So we're still short housing. So even though there's a lot, more lots coming on and houses coming on in the CSRA, we're still pretty far behind where we should be. So I think inventory will continue to stay about where it is. It may tick down a little bit if rates come down, but to be honest, it's a good thing because we may come into a situation, call it spring or summer of this year, where low rates meets high inventory results in a lot of activity.
Yeah, and it's absolutely that's going to happen. And it's funny how the public watches and notices things differently. I got a call from my mom this morning on the way over here. Yeah. And she said, hey, there's all of a sudden out of nowhere, there are 4 houses on the market in our neighborhood. And we never see houses on the market. So, people see that. So it's good to have some more in-depth, analysis of what's caused.
If you think about it, even back when my family and I were living in Atlanta, that was, in between the recession and the rebound. A normal market, you'd, go online or drive around and you'd see signs. Yeah. And moving was an option. Mm-hmm. But from 2016 through COVID, there's just nothing on the market. You've got to work with your agent to find something that's not yet for sale. And there's a lot of sales that come from just networking and what we call matchmaking. But we're getting back to the period where you can actually take your time to find the house that fits you. And again, I think if rates come down a little bit and there's a lot on the market, it's going to be more and more active for our clients and for our agents.
So you mentioned the interest rates. Talk about that a little bit. Where do you see it going? I mean, I know, everybody was so spoiled just not so distant past with those super low rates, but yet still that 6 range is still
it is
a good rate. Are people starting to get used to it, or where are we at with that?
I think that's a good way to describe it, of getting used to it. If you look at historical interest rates over the last even 30 years, 6% is still a really good rate.
Yes.
And I'm not even talking about the hyperinflation back when my parents were buying their first house at 17%.
Yeah, absolutely.
But even just in the not so distant past, 6% is still a pretty good rate when you look at the historical average. Yeah. And what I've seen recently is a lot of the economists that I pay attention to have all kind of agreed that 6.5% is a pretty magic number. That activity seems to really spike when you have rates at 6.5 or below. For whatever reason, there's the math that's being done on what your monthly payment would be is close enough to that 3 or 4% that people got locked in during COVID to where if they need to move, it makes sense. So right now we're sort of right around there. I think that if we get 2 to maybe 3 rate cuts from the Fed this year, obviously Fed rate cuts don't immediately result in lower mortgage rates. But if you look at where people are forecasting the 10-year Treasury to go, I think over the next 6 to 9 months, it looks like we'll get into those low 6s, maybe even high 5s.
Yeah.
And I think that that's where you're going to start to see a lot of activity because it starts to make sense. So, like we've talked about many times, the 2 big things that the Fed looks at are inflation and the labor market. The labor market continues to be a little soft, which normally means they cut rates. Inflation has calmed down a good bit. And so if those 2 things sort of stay in check and we don't have some big, geopolitical event or something like that nobody can foresee, I think that we'll start to see rates continue to creep down. Now, they're not going to drop, like you said, back down to 3 or 4 anytime soon. But I think that if we could land in the 5.5 to 6.5 range, it's going to spur activity because I think people are going to realize that, it's probably going to be that rate or close to it for the foreseeable future.
I think it's safe to say, if you agree, that rates are going to drop. We just don't know how much and how fast, but I think it's safe to say they're not going back up anytime soon.
Right. And I think too, it's not just, going up or down. It's the rapid pace. So that's what was so strange was during COVID, you had them drop so fast. And then they went up so fast. So now every time the Fed meets, you look at the media and everybody's like on pins and needles. Fed meetings should not be that big of a deal. They just shouldn't. And so, it's sort of like, are rates going up or are rates going down? Well, that is kind of just a part of a normal economy. But what's not going to happen is you see rates drop by 2 points in a year and then back up 3 points the next year. I think we're starting to get to a more normal and a more balanced relationship between the housing market and what the Federal Reserve decides to do.
Yeah, I couldn't agree more. And, when you look at the real estate market and the overall economy, there's so many things that dictate how that flows and how quick it can happen, world events, whatever. So many things we don't know. But I do know that the real estate market drives the national economy, and then the economy also drives the rich. It's like a give and take.
Sure.
So, my feel is the overall economy is good. I mean, things feel good, right?
Yeah.
But you study that pretty close and look at a lot of different segments of that. So elaborate a little bit on where you see the local economy and the overall economy and where it's going, and local too, if you want to throw that in.
Yeah, sure.
That's important.
It is important. And I think it's important too, because to note kind of up front that at least as far as the CSRA goes, we are not built really on a boom or bust type of local economy. You've got a lot of healthcare, a lot of government, not only Fort Gordon, I guess it's now called Fort Gordon again.
Right, it is.
But SRS, all of those different things provide that maybe we don't hit the high highs of an Atlanta or a Tampa or places like that, but you also don't get a lot of the low economic lows because there is that underlying, whether it's healthcare or government infrastructure, that helps. So that's kind of a bright spot for our local economy. I think for the larger economy, if you look historically, home sales really tend to follow the S&P 500. They really do. When the market is doing well, people have more value in their portfolio, whether that's a 401k or IRA or whatever, and they feel better kind of generally about the economy. So one thing that's been interesting, though, is I do think that coming into this year, there will be a little bit of pullback on the stock side. I really do. I mean, everybody is saying not only, if, but when.
Right.
And I think that is true, because when you look at the earnings ratios that some of these stocks are trading at, it's just out of whack. It's out of whack with earnings. And to be honest, a lot of that's led by AI. You look at a stock like NVIDIA, I mean,
Right.
just the record breaking run that it's been on has been amazing, but that's not sustainable. And
Hmm.
so I think that as people start to work through AI's effect on the economy, what does that do to the labor market? I do think that stocks are just still pretty expensive relative to earnings right now. So that normally means a little pullback, but I don't see a recession. And I don't think a lot of people are screaming that from the rooftops. As it relates to, real estate and the impact on real estate, affordability is starting to come down a little bit.
Yep.
And when you look at affordability, you're talking about how much people need to make in order to buy a home plus
Mhm.
mortgage rates.
Yep.
Those are your big factors there. And as we talked about, rates are starting to come down a little bit. Pay scales have increased a little bit. And so I think that affordability is going to get better.
Yeah.
Which is good, but that also means talking to your sellers about the new reality.
That's
This
right.
is not 2022.
Right.
And I've even seen a few houses around our neighborhood get listed recently, and my first thought was, "Man, that seems high."
Yeah.
It seems high. It may not be, and there may
Right.
be people out there that are willing to pay for it, but I think that our agents at least do a really good job of talking to those sellers about what the new normal really
Mhm.
looks like. And by new normal, I really mean a balanced market. So the last thing I'll say too is just you look at an overall economy. We don't really have a lot of the tariff issues that
Yeah.
we had last year, which people were uncertain.
Mhm.
And I had an economics professor in business school say the number one thing that people look at to determine a health of the economy is not necessarily good or bad news, but predictability.
Yeah.
So, there's super smart people that are on Wall Street that drive a lot of the financial side of our economy. And if they can predict kind of where things will go, it's a lot more
Mhm.
even. So
Mhm.
their sort of philosophy is, even if it's bad news, give me the bad news. But what
Right.
I can't deal with is unpredictability.
Yeah.
So I don't see a lot of things on the horizon that would really shake too much up on that outlook.
Mhm.
I do think that it's getting back to a more level and even economy, which means a more balance between buyer and seller market on the real estate side.
Yeah. And you mentioned affordability, which
Mhm.
when we do strategy meetings within our leadership team, we look at that as being one of the things we got to pay a lot of attention to.
Right.
I mean, it's can be a concern,
Yeah.
and it has been with prices of the houses creeping up, and as you
Mhm.
said, wages
Right.
and rates, all that plays into that. So
Mhm.
affordability is a concern. But when we were talking, I think yesterday,
Mhm.
you made a comment about some litigation that was going on that
Sure.
could be a help potentially to affordability
Right.
in our market in general. Can you talk
Yeah.
about that a little bit?
So one of the each year the current administration sort of puts out kind of their goals for the year, and they have obviously President Trump goes around and does a lot of speeches, and in those speeches they're different than any other president. They kind of talk about the important things they're focused on.
Right.
So one of those that President Trump and his administration are focused on is affordability.
Mhm.
And kickstarting what he referred to as a frozen real estate market. That's the
Yeah.
way he described it. Those are
Right.
his words. And I
Yeah.
think it's a good description because you've had high rates,
Mhm.
low inventory,
Yep.
and everybody that's in their homes got a low rate.
Yeah.
So what are some of the things that you can do to unfreeze,
Right.
that frozen market? And it's several things. So the first thing that came out yesterday was President Trump was very clear that they are working on legislation to ban institutional investors from buying large amounts of single family homes.
Yep.
Now, what that looks like, I don't really know. How many homes will they be able to buy?
Mhm.
The number I've heard is around 100 at a time.
Yeah.
Maybe they put parameters out there, but what they're really trying to combat are the BlackRocks and the JP Morgans of the world from going in and owning thousands of homes.
Right.
Because as you can imagine, when there's a bidding war for a home that's going to be used as a rental, the
Mhm.
value of that is based on a cap rate. And a large institutional investor can stomach that
Right.
a lot better than a family of four can.
Right.
So who do you think ends up winning that bidding war? It's the institution. And
Yeah.
so I do actually believe that there is a little bit of artificial inflation
Mhm.
of housing prices due to those institutional investors. And I saw in the article that I read about Trump's speech yesterday where it said that in Atlanta, Charlotte, and Jacksonville, 15% of homes are owned by an institution. That is a
Wow.
lot.
Yeah,
I mean,
it
that's a
is.
lot. And when
It
you
is.
think back in 2011, there wasn't a single institution that owned more than 1,000. Now
Mhm.
there are 20 that own more than 3,000.
Right.
So this is not a historical thing. I mean, this is
Yeah.
a pretty recent phenomenon. And I think we're
Mhm.
just now starting to see the effects of a neighborhood
Yeah.
when a third or a fifth of the homes are owned by an institution
Yeah.
that has a renter in there, and all of a sudden that changes the dynamic of the neighborhood. So Trump's quote yesterday was, "Institution or corporations don't live in homes, people do."
Right.
And I think that's getting back to, look, I get it. If investors want to own single family property and rent, that's good. That's
Yeah.
good for the economy.
Yep.
But I do think what he's trying to accomplish with this is allow actual homeowners to
Mhm.
get a shot at those homes instead of the institutions who've been buying them.
Yeah, there's got to be a balance there because, and look, I'm in favor of companies and individuals certainly being able to invest and own
Yeah.
rental property. I mean, and real estate's the best investment
Yeah.
out there. But when it gets to the point where corporations can do that, and then it starts affecting that
Right.
American dream
Yeah.
of home ownership to the average family, that's where it gets a little discouraging
Yeah.
because. And we've talked about this before. The average age of the first time buyer is hitting 40 years
Crazy.
old now.
Yeah.
I mean,
Yeah.
that shouldn't be. I mean,
Yeah.
I bought my first one at, early 20s.
Yeah.
And, man, that's something everybody ought to have the opportunity to do.
Yeah, I agree. And honestly, the way that the government incentivizes its citizens, at least financially, is through taxes.
Yeah.
That's macroeconomics 101. And there are so many tax benefits to owning a home.
Yeah.
And that's for a reason, right? They want people to own homes, want people to be able to sell a home. One of the things they're looking at that I haven't mentioned in the past is they're looking at raising the cap on capital gains from $500,000 to $1 million. Because prices have gone up.
Yeah.
And so that's a huge benefit to be able to, if you've owned your home for, many years and it's appreciated in value, to be able to sell that and buy something else and use that money tax-free is pretty remarkable.
Yeah.
So that's something they're looking at too. They're also looking at several things related to mortgages. So we've talked about portable mortgages, which I think would be very impactful, where you can say, I've got a 3% mortgage on my current house. I want to buy a house down the road. I can take that 3% mortgage to that house down the road.
Yeah.
So I think that has the potential to be really important. And it's also already being done. Like you look at Australia, for an example, part of what they have to do to have a robust economy is they have to convince people to move to Australia.
Right.
So, so that's normally from Asia and Europe. And so what they do is, as rates get low, they say, you can have this portable mortgage. If you live in London, for example, and you want to move to Australia, you keep that 3% rate.
Right.
It entices people to want to move. So it's been done in sophisticated economies, which I think is a pretty interesting idea. And then the other thing related to mortgages is Fannie and Freddie potentially going public.
Yeah.
That will change the dynamic a little bit in terms of the programs that they can offer, the transparency and the disclosures that they have to provide. And then the other things too that I think that the Trump administration is really focused on is people who don't currently have access to be able to buy a home. So first-time home buyers, folks that, they're like, I really want to buy a home, but even locally, a new home, starter home in one of, the neighborhoods that we have is what, 360, 400.
Yeah.
I mean, that's not attainable for most people. And so whether it's loan programs where you have to put down less, some other interesting things I've seen is sort of a rent to own type model to try to, like you said earlier, people are buying houses later. They're also having children later. They're also getting married later.
Yep.
And so what that means is that they're renters longer for the most part. And so trying to get into that life cycle of your typical family to get them in the home ownership process a little earlier, I think you're going to see that. I think you're going to see 6 or 8 pieces of legislation get proposed here in the coming months. Who knows what will pass, but I'm optimistic because I think it seems like both people on the aisle want to unfreeze this frozen market for the most part.
Yeah, and it's good to have an administration that is focused on home ownership and affordability.
You're right.
And I've heard the talk of the portable mortgages. I've heard talk of maybe expanding or extending the term from 30 to 50 years.
Right.
And it's a kind of
I
guess that's a double-edged sword.
It is. It is for sure.
It can be good or bad.
Yep.
But it's good to have that done. If they can do it through legislation, that's great. And I think when I asked you about it earlier, I might have said the word litigation, but that's
I knew what you meant.
Different word. I meant legislation.
No, I knew what you meant.
Litigation. Is there anything there that we need to talk about?
Yeah, I mean, we still are living with the aftermath of the NAR litigation and the settlement, and that's still being worked out. I think, fortunately for a company like ours and a market like ours, it hasn't had a tremendous impact.
Right.
I think we're going to start to see the impact, and we can do, probably 10 podcasts on this. It's going to continue to change how commissions get paid.
Yeah.
It's going to continue to change who pays them. The relationship between buyer's agent and buyer, seller's agent and seller. I overall think that those are good things.
I do too.
I think it's a more accurate reflection of how the process and transaction should be handled.
Agree.
I think that some of this stuff, for lack of a better term, that came out kind of after the litigation and settlement, I didn't really love, because I thought that it made things complicated for no real reason.
Right.
But having that not, hopefully, knock on wood, having that sort of settled out a little bit, I think has also given our clients a little bit more peace of mind, just because there was so much media stuff out there and so many articles that just didn't get it right, that people were sort of like, should I sell my house? Should I use an agent? How do they get paid? All that stuff. So I'm hoping that means that, again, in terms of predictability, that there's a little less of unknowns when it comes to buying or selling a house.
And I got to say, I feel good in the wake of the lawsuits and the settlement, NAR settlement. It was scary going into it, a lot of uncertainty and a lot of uneasiness. Mm-hmm. But I got to say, I feel good about where we are and where we're headed with it. Yeah. And I agree with you. I think if you really, I know change is never easy, but when you really start diving into that, it is better, I think, for the client, which is ultimately the goal. Yeah. And so, I mean, I really feel good about where it is and where it's going.
Yeah, no, I agree. And I think too, just as kind of a last thing, I think that what we are starting to see is the market start to normalize a little bit. There was so much, for lack of a better term, funky stuff going on. And what I mean by that is so much government intervention, so much money being pumped into the economy during COVID. Mm-hmm. Everybody went crazy and bought a house or two during COVID. Yep. Prices went crazy. Interest rates were going way down, and they went way back up. I think when you look at all that, plus, I remember when you and I would go to conferences right before COVID. Do you remember the number one topic? It was iBuyers. Everybody was talking about iBuyers. Right. Yeah. And that was like the talk. And sort of like how AI is today. Uh-huh. But I remember that. And that corrupted, I think, the market too. And that's related to what we were talking about with institutional buyers, because what you had is all of these different platforms, including Zillow, who would go in and buy your house. They're like, hey, you want to list your house? Well, what about this offer? Will you take it and we'll buy it? And that makes sense in maybe like a residential development in Scottsdale where every house looks exactly the same. Yeah. But if you come like into a historic place, like if you go, maybe on, Walton Way or somewhere on the hill, and you've got 3 different homes, they could all be very similar square footages, same bedrooms, same baths, and those are 3 extremely different homes. Absolutely. So an algorithm that they use to price those homes and everything else, that's what Zillow found, and Zillow lost millions on their iBuyer program because those houses are not comparable. Right. And so you had all these players involved that were doing things that the market didn't dictate and paying prices that probably didn't match what the house was worth. Mm-hmm. So I'm hoping that with some of this legislation that's coming in and with rates coming down a little bit, and with some of these larger players who weren't interested in the American dream and weren't interested in home ownership, as those start to claw back a little bit, I think you'll find hopefully a healthier and a more quote unquote normal market. Mm-hmm.
Agree. And it's just amazing. Our industry, I mean, I don't know how long we've been talking, 20 minutes, but we could sit here and talk all day long. Yeah. It's such an in-depth the different segments that make it all work.
Yeah.
So I want to thank you for giving us some
Oh,
insight
yeah. Happy to do
today.
it.
And I've enjoyed it. We'll do it again. There's so much to talk about, so many topics. But to everybody who joined us today, thank you so much for being a part of this with us. We would like to do different topics, and we'd like to do ones you want to see. So if there's anything that's on your mind, something you'd like to know, just reach out to us, and we'll see if we can get a podcast together on it. So again, thank you for joining us on the Maybom Perspective, and we will see you soon.
Great. Thank you.